Hi, everybody. Welcome to another edition of the Endeavor Exchange. Really excited to have another special guest back again.
Hello.
Dennis Rubeniuk is joining us today, and Dennis has a particular expertise in people advising people that are getting close to retirement in particular. And so I'm excited about this topic because we were just talking about this is something that affects so many people every single year. Making the most of your pension is the title. But there's so many things that go on, and just in the last week, I've had a couple of clients who are facing some of these exact questions that we're going to be talking about. So I'm excited about this topic today, and really exploring the options that people get with their pensions. And also, there's been some changes recently from the Manitoba government, which are really exciting as well. So, without further ado, I'm going to let you take over. But I think a lot of people, when we think about the biggest financial decisions that people are going to make in their lifetime, most people have their house or real estate in mind when they're thinking about that. But that's not always the case, right? I mean, looking at pensions in particular, it's often could be the biggest decision they ever have to make.
For sure, yeah. I think a lot of us hear that buying a house is the biggest purchase you're ever going to make, which I think makes sense. When you really look at a pension, that can be not just the biggest purchase. It's probably the most important or biggest financial decision that a lot of people will make. Especially people that have been in a job for 20 to 30 years working in that job, and especially if they've made a decent salary, the value of that pension could easily be worth more than the house that they bought, especially if they bought that house 20, 30 years ago.
Yeah.
So it's not even just the value of the pension itself, but it's also how complicated it is as well.
Right.
Usually when you're just buying a house, bank approves you for a certain amount, you go shop, find a house you like, buy it, and then you're done. But with a pension, there's a lot more that goes into the decision-making process, as well as it's going to be affecting you for potentially 15, 20, 30 years, and not even just yourself and what your income is going to be for the rest of your life, but also what you might have left for your beneficiaries when you're gone as well. So there's lots to think about, and yeah, like I said, the value of it itself could easily be more than the price of a house. So it's definitely something that big decision to make, important decision, lots of factors go into it, and something that should definitely get some advice and expertise on.
Yeah, I mean, it's not out of the question. I mean, more recently we looked at pensions that ranging $600,000, $1 million, $1 million plus, and a lot of that has to do with interest rates and things like that. With low interest rates, the dollar amounts or the value of the pensions go up. So yeah, I mean, you think about your average house price here in Winnipeg. I actually don't remember the price off the top, but in the $300,000 to $400,000 range, give or take.
For sure.
So when you're looking at pensions, I mean, you're looking at $500,000 plus quite easily.
Lots of times.
So yeah, absolutely, it's potentially the biggest decision they're going to make. I think so. There's still there's still a lack of clarity around the options that people get when they're looking to retire. And what options to take. I mean, I think most people understand. We're talking more specifically about defined benefit pensions in the most cases.
Usually, yeah.
But I think people understand the option of I can take my pension, I'm going to get so much per month.
Yeah.
But that's really the tip of the iceberg. There's a lot of other options that should be considered.
For sure, and not even just for defined benefit pensions, but even defined contribution pensions can give you quite a lot of different options when you go to actually retire. So once you do retire, past your official retirement date, you're going to get a pension option package in the mail usually. Once you get that, and every pension is going to be different, different amount of options, different choices, everything like that. So it really depends on the actual pension and who you were working for to determine what your options are going to be. But in general, they're going to have a lot of the same options. So like you said, kind of the first thing you usually think about with a pension is, yeah, you're going to get X amount of dollars for the rest of your life. But that is just kind of the first option. And even with the monthly pension option, there can be, I've seen up to 18 different choices of how many different monthly pension options you're going to get. And that's just, the monthly option. So aside from taking the monthly option, there's also usually an option, and not every pension option offers this, but to transfer the lump sum value, like you're saying, the 600,000 or $1 million or whatever it's going to be. So those are usually going to be your kind of two main choices, and there's a lot that kind of goes into the decision-making process of, which one makes the most sense for you, and that's where, people like us can help.
Yeah, for sure. I think to your point, you look at all the options, even on the monthly benefits. And I mean, there's survivor options to consider, like 2/3, half, 100%. I mean, and what are the ramifications for that down the road, kind of a thing. So yeah, needless to say, there's a lot of different things that can play out in a pension plan, and knowing kind of what the future looks like. But with all those options and choices, where does someone even start? I mean, again, I think
Yeah.
I think of you as like an expert in this field because, leading 5 years out from retirement or even within that last year before retirement especially, there's a lot of things to consider. So where does somebody start figuring out what makes the most sense for them? And how would you help? What would be your approach to helping people understand what those options are?
Well, first, it's kind of taking a look at all the different options in general. And also, it's not just the options themselves, but also what your situation is. And like we talked about, the different options that there could be. And just to give you an idea, I've seen pensions in general. The couple different options you're going to have is, first off, there's going to be a couple different options, especially if you have a spouse for which your survivor benefit's going to be.
Yeah.
Because usually, if you were to pass away, you can either choose that your survivor or your spouse would get, the full benefit you're going to get, 2/3 of what you were getting, or even just half of it. And usually the way it works is that the bigger the benefit they're going to get usually means the less that you will get. So you have to kind of weigh the pros and cons of the different options there. Now, with each of those three different options, each of those three options can have, 3 sub-options of a guarantee period, which really is just, how long the pension's kind of committing to paying that money out for. So we've got 3 different survivor benefits. Each of those benefits can have 3 different guarantee options, and all of a sudden we're at 9 different options right there. Now, wait, there's more. Just like a good old infomercial. So with those 9 different options, if you're retiring before 65, sometimes your pension's also going to give you like a bridge benefit or an integrated option as well, which can really just double the amount of options that you have. And really what the bridge benefit is, it's going to give you a higher amount of money up until you're 60 or 65, and then it's going to decrease after age 65. So it depends kind of on life expectancy, family history, and even just your own income needs, what you're going to need for retirement to make the most sense. But again, that's where we can see that you can be looking at a pension option package with 18 different options and not even knowing where to start to begin. And that's again just for the monthly option, not even looking at the commuted value transfer.
Right.
So where I like to start, and definitely experience helps, having helped a lot of people with all their pensions, make those decisions. And it's not me making the decision for them. It's really helping people understand the pros and cons of the different options, and also what makes the most sense for them.
Right.
It really helps them decide and make the decision for themselves. So that's kind of the process I like to use. And usually where I'll start is, at least with the different monthly options, is kind of narrowing down, first off, the different survivor benefits. We're going to take a look at, for their personal situation, if they do have a spouse, what's the spouse's financial situation? Are they somewhat self-sufficient? Do they have their own retirement savings? Will they have their own pension? And ultimately, how much of your pension will they need to live on if you were to pass away? So that's going to help narrow it down from those first 3 options of the survivor benefit, just kind of down to one choice. From there, we'll take a look at the different guarantee periods, just to see what makes the most sense. Because again, the longer you're getting a guarantee on that pension for, usually the lower your monthly pension is going to be as well.
Right.
It's not really a big reduction, and usually this decision's a little bit easier, but still, it's another thing that we have to narrow down. And then the last option is, if you are retiring before 65, we take a look at the different integrated options. Do you want to take the standard option or the one where you're going to get a bit of a benefit, like the bridge benefit, if you retire early? So once we've kind of narrowed that down, we usually end up with, of those 9 or 18 different options, narrow it down to just one number that we can kind of work with. And then that's going to let us compare, if you take the monthly option, you're getting X amount per month. We can actually do more of an apples to apples comparison of, if you take the transferred option, how long that you can still get that same payment out and have it last, hopefully, for the rest of your life.
Right.
So that's kind of the approach that I usually take, and it helps people, make more of an apples-to-apples comparison. It's when you see that statement and all the different options, it's a kind of a mess. It's really hard to start, but once you kind of get it down to an easier to make comparison, it at least lets you decide. Do you want to do the monthly option or the
helpful to eliminate the options so that are a no-go right away. So
process of elimination.
Yeah,
for sure.
Exactly.
Yeah.
The guarantee is one, and that's something we've seen a lot more of in the last few years. Mm-hmm. I find that one's one that clients tend to get tripped up on.
Oh, okay.
And, because they'll have like a 5, 10, 15-year guarantee, potentially, something like along those lines, depending on the pension, of course. And I think that a lot of people get tripped up on that because, having a guarantee is a really nice thing, but at the same time, as you point out, like the cost of it, when you're looking at the reduced monthly benefit, potentially for your entire lifetime, and the reality is, statistically speaking, most of the people that are retiring probably will not pass during the guaranteed period of time. So you might be paying for a benefit that your family will never take advantage of. For sure. I mean, again, to each their own. I'm not sure if you've ever encountered situations where the guarantee made sense, but in most of my experience, it was more a matter of, okay, you might want the peace of mind, but statistically speaking, they're not going to take advantage of it.
Yeah, usually speaking, most people probably will live past the guarantee period,
Yeah.
so it's not as big of an issue. And I think that really speaks more to taking the monthly option versus taking the commuted transfer option. Because if people do live past their guarantee period and they or both of them pass away, really the pension's kind of off the hook for paying out. Whereas if they took the commuted transfer option, even if you're 15, 20 years into drawing down on that, like we were talking about, there could still be a significant amount. Now that amount can go to your beneficiaries or your survivors. So that's one thing that's really played in quite largely to decisions that my clients have made is, being able to see, okay, 20, 25 years down the road, what's projected to still be there, if they were to pass away. Because if you take the monthly option, even if you took the 15-year guarantee period, you're past that point, and if the worst is to happen, then basically there's nothing left for the survivors.
Right, exactly. Which kind of leads me into my next question, which is related to that commuted value, because I think that's a bit of a black box, if you will, for a lot of people. They're never really taught about that option. They're never really good. Like, there's not a lot of communication around it. But so with the commuted value, who would you say is suitable for that option? I've got a follow-up to that, which would be, what are the pros and cons that are out there for this option in transferring the commuted value?
Yeah, and kind of like you mentioned, the commuted value being a black box, it's not something where you just get X amount of couple $100,000 and put in your checking account or anything like that. The way it works, I guess, is to kind of explain that part, is really you're transferring out a lump sum, a couple $100,000. It goes into what's called a locked-in account. It can either be a LIRA or a LIF, not to get too much into the acronyms or whatnot, but it transfers directly to something similar to an RSP or a RIF, but there's just a withdrawal limit you can take per year. And with that money, again, you can invest it, meet with an advisor, determine your risk tolerance and invest it as you see fit. And basically the returns that you're making is really going to determine how long that money is going to last. So that is something that really kind of plays into who the commuted value transfer option is good for. Because I think when you actually crunch the numbers and run the programs and things like that, you'll see that if you're not really comfortable taking risk, and just with interest rates being the way they are, guaranteed investments probably making less than 2% per year, usually that money's not going to last quite as long as it's going to need to if you do the transfer.
Right.
Whereas somebody that's at least comfortable with a conservative or a balanced portfolio, even if you're making 4 to 5 or even 6%, that money can last quite a long time if you're taking out the same monthly payment that you would have had if you'd taken that monthly option.
Which is the key, really.
For sure,
right?
yeah. So it's a nice way to just, again, illustrate people that, if you had choice of X amount per month or this lump sum, it's an easy way to figure out, how long that lump sum is going to last if you're taking out that same amount. So first off, like who it's appropriate for. Probably, the lump sum transfer would be better for people that are comfortable taking a bit of risk, unless we see interest rates get back up to 5 or 6%, which probably is not happening anytime soon. Yeah, and as well, there's a bit of responsibility as well, because with the commuted transfer, there is some flexibility in being able to take out a bit more early or unlock the pension and get more access to it, which is nice to be able to customize and be able to take more out than you normally would have. But the flip side is you may shorten up the life of that pension, so you have to be careful of that, because it's kind of a double-edged sword of being able to have more flexibility. You just don't want to use too much and run out of money down the road.
One of the things that I've often talked to clients about when exploring this option is, to your point of customization of income, it's really nice because the way that a typical defined benefit pension works is that the income will increase over time with a cost of living allowance or inflation, and so that kind of works backwards typically with like lifestyle expenses, whereas a lot of people in retirement want to spend more money when they're younger, they're traveling more, they're doing more things, they're more active, they're more mobile. And then later on in life, they don't need as much money or they don't want to have as much money. So so the commuted value option can create a little bit of a benefit there where you can customize it and you have a bit of a step ladder down. So typically at age 80 or 85, we're reducing our clients' income down, giving them more access earlier on, and so it does offer that benefit.
Yeah.
I think the survivor benefit, but also the estate values is another interesting component to the in terms of pros towards the commuted value.
For sure. Yeah, because that's a big determining factor for a lot of people making that decision, again, is just seeing what could potentially be there, after the guarantee period's done for their beneficiaries or survivors if something is to happen to them, versus, if you're after 16 years, you're past the guarantee period, there may be nothing left for the survivors aside from, any other RSP savings or home equity value, things like that. But to actually have, a significant portion of the pension left to possibly go to your survivors, is a big factor in people's decisions.
So you think about even like people with like dependent children, they're adults but dependent children that they maybe want to be supporting later on, or even the fact that it's like, hey, I've worked really hard for this pension my whole life.
Yeah.
I'd prefer that not to be dispersed to everybody else. If I were to pass away prematurely,
Yeah.
I'd want my kids to inherit it, or my family to inherit it. But and I think even like when you're looking at those monthly benefit options, so as with a higher survivor component. So if you're looking at the monthly payout, so going from 2/3 to maybe 75% or 100%, the higher the survivor benefit, the lower the initial monthly benefit, right? So, but with the commuted value option, if the money's coming out, the money transfers tax-free to your spouse if you were to pass away.
Exactly, yep.
So theoretically, the income level could remain the exact same because the asset just transfers as it is.
Yeah. Yeah, and ultimately you just have a lot more control and flexibility doing the commuted transfer option, whether it be doing the unlocking or transferring to spouse or whatnot after you pass away. But yeah, really instead of just choosing one of a couple different monthly payment options, you can customize things a lot more.
Right.
Even not even just how much you're taking, but even when you start. If you have other savings you can live off of, or maybe you're just going to end one job but still work and maybe don't want to start receiving that pension yet, you can just transfer it to the LIRA, not start drawing on it. You can let it grow for a few more years and then start to take money out. So,
right.
And like you said, I find the same thing with a lot of my clients as well. When we do planning, we do kind of, almost look at it as even 2 to 3 phases of retirement, depending on when somebody retires. You're probably going to be more active and just physically able to do more fun stuff early on in retirement. Like you said, after 80, 85, body slows down, you're not able to do as much. You may have more healthcare expenses, but aside from that, you're not able to do the fun stuff and travel as much. So a lot of people want to enjoy that money more. Right. And I think doing the commuted value kind of gives them the flexibility and access to do that, enjoy more of their retirement when they're more physically healthy, but still also have money down the road for when they're, slower down.
Yeah, and it's truthfully, it's not for everybody, the commuted value option. There are certain advantages it has, but it's definitely not for everybody. And if it was going to be treated like a lottery win, for example, it's not a lottery win.
No.
It has to be treated, to your point earlier, it has to be treated like your regular monthly benefit that you would have received. And if you can handle that, then it could be a good option.
Yeah.
Now, we talked about specifically on increasing income or providing more income to people earlier on in retirement. Mm-hmm. This also gets into like the bridging benefits. So do you think those make sense for most people?
I've seen it probably more on a case-by-case basis. And first off, it really depends if your pension offers it, as well as when you're retiring, it may not even be an option.
Right.
And then again, it's also so different based on everybody's needs. Again, if people want more income earlier, it also depends if they have other savings to kind of finance them down the road when, if they took the bridge benefit, get a higher payment earlier on, but at 65, it's going to drop down. Mm-hmm. Mind you, at 65, you can apply for CPP if you're not already receiving it, or OAS, which is kind of the intent is that replaces, kind of supplements your income after the bridge retirement drops down, or the bridge benefit drops down. But again, it's so many different variables. It's more, I'd say, on a case-by-case basis. And even even though seeing the actual numbers are when you get the pension option package to see what the increase is going to be, and also how many years you're going to get it before it drops down, and even life expectancy plays in as well. So it's kind of hard to make a rule of thumb judgment for everybody, just because everybody's situations are so unique and different, as well as even just the options that they get from the pension could be different as well. So.
Yeah, it's like I have seen, especially with people working longer. We've seen many people in many professions working longer. I've seen certain options. I won't name the companies, obviously, but where you have to the member is like paying for a bridging benefit, but if they're retiring after 65 because they just enjoyed what they were doing, they essentially have paid into this program which they never take advantage of, and they don't get the money back. So. There's definitely a case-by-case basis to your point.
Yeah. Kind of like you were mentioning about not getting the money back. I think that's one of the things, and even just looking at the potential amount that would be left for survivors if you pass away, is you don't really want to leave a couple $100,000 on the table if you pass away early. And that's one of the things that, although the monthly benefit option, you're going to have income for life guaranteed. Mm-hmm. Again, if your life doesn't last that long, you could be potentially leaving money that could go to your beneficiaries if you didn't do the transfer. So
yeah, like if somebody's has a terminal illness, for example, especially
for sure,
that's a situation where it's like if you were to pass away within a few years of retirement, your family might be disinherited, if you will, from a large portion of assets that you've built up. So. We started off by talking about some changes that have recently come into effect from the Manitoba government in the Manitoba Pensions Act. So maybe you can touch on this, because I've seen, I was joking, because I've seen a lot of advisors just share the link to the Manitoba government site, and we all know that anybody that's gone to a government site they're incredibly difficult to read and understand, even for professionals. So, so maybe you can shed some light on what actually the changes happen, so in lay terms, so everybody can kind of understand what's going on here.
For sure. Yeah, that's one of the reasons that I wanted to bring this up as a topic. Because as soon as I saw the headline, I was, was it an advisor that's done a lot of unlockings for people and helped people get more out of their pension? It's like, oh, this is a win for us. Again, it's kind of double-edged sword that you can't. It can create the opportunity to use the money too quickly.
Yeah.
But really, just to back up a step, like in Manitoba right now, currently what is available if you have pension money that's under Manitoba jurisdiction, at age 55, you're allowed to unlock half of it. And again, that can go to an unlock plan, give you more flexibility to kind of supplement, have a higher income, or do a lump sum withdrawal. And the other real only unlocking option is if your Manitoba pension money is below a certain threshold, which you'll call it around 25,000 or so, you're able to unlock it, because otherwise, taking 7% to 25,000 isn't really a significant amount. So the big change that is coming in, this will be effective August or October 1st, is that anybody 65 or older with Manitoba pension money will be able to fully unlock that. So not even just the 50%. This is actually probably even going a little bit beyond what a lot of other provinces have gone to. Either federally or other provinces, kind of the 50% unlocking is somewhat standard, but being able to fully unlock that is kind of a big win for both people that have locked in money and as well as advisors and planners that are helping people plan and come up with their income plans.
Yeah.
So that's basically the first one, is being able to fully unlock Manitoba pension money at age 65. Beyond that, there is some other unlocking provisions for people kind of suffering financial hardship. So people with expected low income, facing eviction for rental arrears, mortgage foreclosure, or dental or medical expenses that aren't covered, they're able to unlock pension money for that as well. And another thing as well is that anybody going through marital breakdown, previously the other options were just to either transfer kind of half or the full amount. Now you have more flexibility in how much you're splitting the pension up as well. So a few different, a few changes, one of them quite major. Again, double-edged sword. You don't want to unlock everything and go through it really quickly, buy yourself a fancy car and not have any money left to live on for the rest of your life. It's not a lottery win. Yeah, not a lottery win. But again, just depending on people's circumstances, may give them that flexibility that they didn't have before.
Right.
So I think it's a good thing. And again, it's something you'll want to get some advice on before you make any decisions and do things. So that money is taxable as you take it out as well, which is another thing to consider as well.
Well, I think, yeah, and to that point, I mean, I think this helps potentially on the estate planning side as well, because as people are, when we're looking at plans and we look at virtually every year for the rest of a client's life, we project out typically till age 99, just to look at what potential roadblocks they might hit down the road. But even if you looked at like around age 90, people are living longer, and that's the reality. I know a lot of people are like, well, I'll never live to 99. You know what? I have a number of clients well into their 90s, and we have a number of clients here that are well into their 90s, still living somewhat active lives in good health, and so. And guess what? We had to plan for that. Otherwise, I joke that I don't want to tell anybody they have to go back to work at age 90. Because that's not a good situation to be in. So we're planning for those things going forward. But one of the questions that comes up for people, though, is when we're looking at the account values, especially registered accounts, is when the day the last the two of the spouses passes away, or if it's a single person, the day they pass away, what happens to that money? Unfortunately, I'm going through this with a client right now who's passed away, and I'm working with their family at this point. But they passed away at a very young age and had all this registered money that's now taxable as income to their estate. So hundreds of thousands of dollars potentially in tax liabilities there. The unlocking could potentially give you a way to melt down that registered money periodically and reduce that terminal tax bill basically. So I see it as a win for that from that perspective as well. Not to it probably doesn't overshadow the flexibility on the income side for most people though.
Yeah, but again, just another kind of benefit, like say, drawing that registered money down gradually, paying tax on it little by little every year is going to reduce your tax bill quite a lot than potentially facing a big estate tax bill.
Yeah, now naturally being the financial planners that we are though, I also see the flip side of this, and my worry is that people go and melt down their assets too quickly, and so I think that it's really important that anybody considering this option should have a good financial plan in place to evaluate. What is the ramifications of this decision? What are the consequences of these decisions? And if I start taking more out, what does that mean for me at age 80, 85, 90? Because again, it's a really bad. You don't want to go back to work at age 90. I mean, it's not going to be fun for anybody. So.
I think just one other point is that, working with advisors, instead of, we don't just look at the pension part on its own, we look at everything all together. So we can come up with a plan of, how does the pension fit in with the CPP and the OAS and retirement savings, and come up with a plan to go, how do we melt down that RSP money tax efficiently, and even if people aren't needing it for income, put it back into a TFSA or things like that. So, not even just for advice on pension options, but even just the whole retirement plan in general, that's where advisors really have value.
Tax at every step of the way, basically.
Every step of the way.
Planning around taxes.
Taxes.
Less tax today, less tax at death, less tax everywhere. Yeah, totally.
We pay enough taxes. Anything we can do to legally minimize that.
Legally minimize. That's the key word there.
Not evading.
yeah, exactly.
Yeah.
So I know there's a lot to consider with all this stuff.
For sure.
We know that, and I think anybody that's going through their pension option package will see that, there's a lot that goes into it, and then sometimes that's a surprise for people. So there's a lot to consider when someone gets their package, and do you have any last bits of advice that, for anybody that might be receiving their pension package either the next few months or even over the next year or two? Like what would you say? What other future advice would you have for them?
I'd say the first piece of advice, the biggest one, is just to get advice and deal with an advisor. Because even if you're still a couple of years out from retiring, depending on when you're retiring, again, like I said, we're not just looking at the pension part, we're looking at CPP, OAS, RSPs, how it all fits together. So when you make a decision on one of those before other parts come into play, it can kind of affect the whole plan in general. Mm-hmm. So for sure, looking at the whole picture, again, whether it's 2 months out from retiring or 5 years out, starting to work with an advisor to come up with a plan, do some projections, see what you're on track for, and also come up with just a strategy to, again, kind of get the most out of that money, pay the least amount of taxes, make sure everything's covered that you need. And then once you do get that package, if you can't sort it out yourself, which you probably can't, then for sure deal. And if you haven't already met with an advisor, then get some advice and help from an expert, because we can make it a lot easier to understand what makes the most sense for you, the pros and cons and everything like that, and help you make the best decision for yourself.
Yeah, I think you've hit it on the head there. I mean, there's generally no cost. I mean, and I know there's no cost to have a consultation with you, Dennis. So, it's generally worthwhile. It's a good conversation to have. As we pointed out earlier on, I mean, there is probably no bigger financial decision most people are going to face than their options related to their pension plan. And so it's not worth winging it.
Yeah, no.
Big mistakes can happen that could really mess up your retirement. You worked hard your whole life to build this asset up. You want to enjoy it. And you want to enjoy it with the least amount of stress possible, and so reach out and get that advice, and so anybody looking to get that advice who's got a pension package on its way or thinking about retiring in the next few years, Dennis, what's the best way to reach you?
You can give me a call, 204-318-2663, or send me an email, or look me up on LinkedIn. Just Google Dennis Rubeniuk, you'll find me. I'm pretty easy to find, so I'd be happy to help. I've helped a lot of other people with their pensions, and looking to help more.
Yeah, or go to the website, because you can find Dennis there as well, www.endeavorwealth.ca. And I think with that, Dennis, we'll close it off. But thanks very much for this.
My
I think
pleasure.
this is a question that we see a lot of, and I know there's a lot of people that aren't reaching out with this question that probably should be, or maybe just don't know where to go.
Yeah.
So thanks very much for providing this expertise in this area. With that, we'll close it off there. Thank you very much for everybody who's attended today, who's watching us live, and for anybody else who's watching the recording, thanks so much. Please subscribe to the YouTube channel, follow us on Facebook, Instagram, LinkedIn. Reach out to Dennis or myself anytime, and we'll be more than happy to chat with you. Thanks so much. Take care.
Take care.